News drives markets, and every day, Montel's experienced reporters are on top of the stories that shape European market developments. Can you afford to miss out? Go to montelnews.com for the latest price-driving stories and a free trial.
Hello listeners, and welcome to the Montel Weekly Podcast, bringing energy matters in an informal setting. In today's pod, we look at the European carbon market and discuss the key issues at play. Quite a lot to talk about. Carbon's rapid price gains are dividing opinions over what forces are behind the benchmark contract doubling in value to above €50 over the past 6 months. Some have said the movement's been breathtaking, others call them illogical, and others overheated. So we've seen some dramatic price movements in recent weeks, and for us on the news desk, we've had to muster all our creative writing skills to avoid too much repetition, as every day seemed to see a fresh record broken. We are recording this on Wednesday, and we are seeing some quite significant downward price movements. So carbon's down, so what's up? Helping me, Richard Sverrisson, to explain current market dynamics and to look into the coming weeks and months ahead are some familiar voices. First of all, Ingvild Sorhus, Analyst at Refinitiv. Great to have you on the pod again.
Thank you, Richard. Great to be here.
Perfect. I had a kind of deja vu recently and sort of was thinking back to August 2018 when you were a speaker at Nordic Energy Days and prices was rising as you were speaking as you were giving your presentation. And then a few weeks later, they crashed. So that's quite of a similar situation to today, really. Although maybe too soon to say crash. But
yes, definitely.
And also Bjarne Schieldrop, Analyst at Sweden's SEB Bank. So welcome back, Bjarne.
Thank you very much. Good to be here again.
Normally we talk oil, but I sense that the carbon is one of your old loves. So you certainly started writing more about the commodity this year.
Yeah, I used to be a carbon market analyst for 3 years from 2005 onwards, just before I joined SEB. And, this is, my primary focus is for our industrial clients, and all of them have a common denominator, and that's carbon. And now with much higher prices, that's certainly a big product for our industrial clients. And that's why I'm dragged into writing about this, and it's a pleasure to do that.
Perfect. And finally, and last but certainly not least, is our old friend Trevor Sikorski of Energy Aspect. So welcome back to you, Trevor, and excellent to have you on board to give your views on what's driving prices at the moment.
Thank you, Richard. Always a pleasure to be here.
Excellent, because you're an expert not only on carbon but also on gas, so I think that should be quite helpful today. You guys kind of know each other, don't you? I mean, you met before.
We're all ex-Point Carbon, so we were all at Point Carbon together back in the day. So it's nice to be back with a bunch of colleagues.
Excellent. Perfect. Current prices. If I can then start with you, Trevor. It took less than a month to get from €45 to 55, and now we've nearly fallen €5 in 2 days. What's going on?
Well, when you look at the carbon run that we've seen today, yes, there has been some supportive fundamentals, but generally it's been driven by a huge inflows of investor money coming in, and investor money is notoriously volatile. We have seen huge amounts going into the options market when we saw the move from, let's say, 45 above 50, which happened, very rapidly. It was something like 40 million tons of open interest going into the call options, right? And so, really driving that, some very high levels of open interest at calls like 50. And there wasn't that much before, there wasn't that much after it. But then we saw, a lot of, I think 10 million tons just go in on Friday. So, a lot of money coming in, it can go out as well, right? And so you can see profit taking, you can see stop lossing, you can see a number of things. So, it is volatile, and when it's driven so spectacularly upwards, usually, there is new money coming into the market, and that's just been one of the primary things. And for an analyst, that just makes it very, very hard to call.
Yeah, absolutely. What's your view here, Bjarne?
Well, it's always difficult to dissect exactly what is the cause and what's the primary cause. And I think one thing we have seen since last summer is sort of a massive increase in the oil price and a massive increase in the gas price, and the natural very large increase in coal to gas switching differentials. So if the CO2 price had gone up exactly as much as the switching differential from coal to gas, then you wouldn't have seen any buying or selling from utilities. They would continue to produce just as much power from coal and just as much power from gas and emit just as much CO2 from each source with no need to buy or sell. So you would just have a higher CO2 price to reflect the new balance. And so that is, of course, a part of the story, a much higher relative balancing point between coal and gas than we had this summer. So that has increased, but the CO2 price has increased significantly, or a bit more. So speculators have driven that up as well on top of that move. And I think the market is always looking for some fundamentals to tie views into them. So speculators as well. They are also looking at coal to gas differentials in addition to politics to try to figure out, what kind of drivers are pushing us fundamentally in different directions. And Trevor, he mentioned that, speculators are transitory. And yes, I fully agree. Over time, they even out and they don't really set the price over time, but they help to move the price and sometimes exaggerate the price move as well. So the upturn has been riding on fuel fundamentals and driven further by speculators. And right now, we see a huge correction in gas prices and likewise also correction in speculators probably trying to do some exits on top.
Fine. Ingvild, what's your view here? Gas, speculators, bit of both, 50-50, 71-30 the other. What's your opinion?
Yeah, it's a mix of several things. I mean, you wouldn't have this rise above 50 if it wasn't for the policy change in ambition. But I think also that we've seen kind of a bit of the similar gas situation as we saw in 2018 when carbon prices were just rising. I mean, the textbook example is when you have a higher carbon price, you will release emission reduction potential because of a higher carbon price. And of course, you move to the power sector then first, where you get kind of this fuel switching taking place then from high emitting coal plants to less emitting gas plants. But now in Europe, you have had a really tight gas situation. So you really haven't had kind of this additional supply to cater for additional demand from the power sector. So carbon could go higher, and then gas has moved higher as well because you have to have kind of a high gas price in order to not trigger this switching price. Carbon could really go higher also because you didn't trigger any emission reduction in the EU ETS in the short term. So I think kind of it's a mix between different factors, as Trevor also mentioned, kind of increasing interest from investors. So, of course, that amplifies also the move that we have seen in carbon.
Absolutely. Trevor, you had a recent note where you said, you actually seen increase in coal burn and in order for now, because the gas storage is at such low levels, you have to have increase in prices to incentivize gas storage. Is that what's going on here as well?
Yeah, I mean, one of the interesting things is we've had a doubling in carbon price and you're going to get higher coal-fired generation this year on year. And that's because we've said this for a long time, it's not the carbon price that drives short-term abatement in power, it's the gas price that drives short-term abatement in power. And the gas market's exceptionally tight. Ingvild, mentioned that. And, it's a combination of, we had a very cold winter, and then we had a cold spring. And so, we came out of March, I think, EU-wide probably 25 BCM short on inventories, and now we're about 33 BCM short on inventories year on year. So, it has gotten worse and it's gotten tighter, and that gas market has moved up and is, in competitive terms against coal. It wants to engender the gas to coal switch because it wants to prioritize, injections into inventories, and that's exactly what's happening in the gas market. So every time the carbon price goes higher, the gas price has tended to follow. And today, we're seeing a big sell-off on gas. A little bit of that is carbon. Quite a lot of that is news coming that Russian flows might not stay as low as people expected, just because the sanctions approach by the Biden government seems to be weaker than expected. That might mean Nord Stream 2 could be on by the beginning of Q4, and that does change the supply and demand dynamics in the gas market quite significantly.
Bjarne, what you mentioned the correction in gas prices, as Trevor does here. what's your view going forward here? Is this likely to continue into the summer and beyond?
I think it's important to note also, just as speculative positions are transitory, so are also the coal to gas differentials, because, coal and gas prices fluctuate over time, and suddenly we have a cold winter, it gets really tight on gas in Europe. And then we have this strong increase in oil prices driving up the LNG prices in Asia. And then you have really a bullish drive on LNG in Asia on top of that, with LNG prices trading at differentials way above normal differentials to oil prices. And given that you have a tight gas situation in Europe, most definitely, then the LNG is the marginal import price. And thus the sort of what happens in Asia on LNG is suddenly hugely important for gas prices in Europe. And when I look at it, to start with, it was the oil price driving up LNG prices globally. And then later, they had their own bullish life driving even further than the oil prices. And now we see a correction in Japanese LNG prices and a correction in European TTF prices as well, and then also a strong correction in carbon prices. So, and I mean, what's the chicken and what's the egg can be discussed up and down, I guess, but the biggest move here has been the oil price to start with, and then on top, a bullish rally in Japanese LNG driving everything up. And you add in a cold winter as well, and then low inventories in the EU, and you have some additional bullish salt and pepper on top of that. But all of this is transitory. I mean, the real fundamentals in the carbon market is politics, number one, and technology, green tech, number two. Those are the real big politics, real big fundamentals in the carbon market, I guess.
Ingvild, Trevor mentioned that it's very hard in these very volatile times to be an analyst and to make these kind of forecasts. I mean, I'm sure you all three would concur with that. But I mean, I just want to ask you about, what does it do to your forecasts? Have you changed your forecasts? And what is your kind of view for the coming weeks, Ingvild?
Totally agree with Trevor that, guessing that the price would be touching 57, almost kind of just slightly out in May, we wouldn't have seen that when we kind of passed New Year's. So of course that makes it tricky, especially kind of in the short term, when kind of, now we haven't really we've only seen prices go up. We haven't seen any corrections until kind of 2 last days. I mean, even though we have huge corrections yesterday, Tuesday, and today, Wednesday, it's still kind of the price level that we passed just a few days ago. So of course that makes it tricky. And it's also kind of trying to dissect the parameters or kind of the factors that are important for the market. Because we all have been in the market for a long time, and we clearly see that the market dynamics have changed drastically just kind of the few last years. And of course, these factors that was hugely important for the carbon market a few years ago, they are maybe not that important anymore. And also how the market is assessing kind of the policy risks are completely different. A few years ago, before we had the phase 4 review, that was kind of the policy risk was considered as huge. And now you have kind of this, you will have a big policy discussions this summer that kicks off really this summer. And kind of it seems like the market has very much priced in quite a bullish case. You have the overall target that is agreed at least 55%, but it's factors there that will be of huge impact for the supply and demand balance up to 2030 that will kind of kick off kind of the policy debate around those issues. Yeah, so it's hard to say, but I think kind of going forward, one, you have the European Commission that will come forward with their policy proposal on how the framework should look like mid-July. So that's one factor that can be kind of steering prices to both ends, I guess, because kind of first the market will kind of dissect what is the proposal by the Commission, and then you will have voices from member states, policy makers in the parliament that will kind of start these vocal discussions, I guess, kind of on their key things that they want to discuss. And also we will have the free allocation for 2021 will be handed out. So that's coming out now we don't have a date yet, but I think it will be kind of now in end of Q2. It's kind of at least the national allocation plan will come out. And of course, this is supply coming to the market as well. So even though it will kind of be short, it should be known mostly to the market that supply is coming. It's been known for a very, very long time, but it was surprisingly kind of big support ahead of compliance that the free allocation was not handed out. So I think kind of these two things will be important. And of course, I mean, we started off by discussing the gas market. So of course, movements in the gas market will be of key factor for also kind of to watch out for the carbon market.
So if I can pin you down to a number then, Ingvild, would you say sort of 45, 50, or will we, what kind of range are we talking about here?
Yeah, I think we will kind of go below 50. Again, somewhere in that range, I guess. But it's also kind of tricky when it's kind of passing. You really don't know kind of what's the new support levels or kind of what's a new floor price when you start kind of seeing this dip buying from industrials, for instance. What do they see as kind of their target price?
Absolutely. Trevor, what's your view here going forward? I mean, Ingvild's highlighted the policy discussions that are going to happen in July and some of the other fundamentals. I mean, what's your view? I mean, do you often have to change your forecast? Do you revise them up or down? I mean, in this kind of situation,
daily, Richard.
Excellent.
Yeah. I mean, we were kind of calling 50 as the top of the rally, just because there was this huge spike of open interest at strikes of 50. And what we saw, like back in 2018, was we certainly saw, a lot of trading around the 20 strike, and volatility around that. But the market went up and then kind of stabilized around 20 with a lot of vol. And we thought maybe that would happen with 15. Now there is, since we called that, of course, we've driven way past 50 and now we're coming back to it a bit. But, I think there's two things here really to look at. There's one, the kind of the short-term fundamentals, right? And those are the things that Ingvild was, some of the things Ingvild was talking about. Certainly, the fact we haven't had free allocation yet for phase 4, has deprived the market of a bit of liquidity on the sell side. The UK hasn't had any liquidity, and that's beginning to start. And we think a lot of the UK installations have been holding EUA hedges to hedge their carbon exposures at the moment. So yes, it comes in quite slowly, but it should release as well a bit of selling. So there's a number of those kind of short-term fundamentals that will be important. But what we've seen, and the harder bit to call, is does the influx of investor money still come into this market? Because if the influx of investor flows continues at the pace that we've seen, then of course it just makes a mockery of saying, of calling a level, because, it can be so big. I mean, we have, if you look at, I would say, the fundamentals over this year, maybe you're saying emissions are going to be 70 to 90 million tons higher, maybe something in that level, right? So emissions are going to be higher. They're going to be higher because of the coal to gas switch. They're going to be higher because of the higher activity that we're seeing year on year from the industrials. So you're going to see both of those go up. Now, if you put that in context of the kind of, open interest we've got in the money on coals, in the money coals at the moment are like 270 million tons. I mean, they dwarf whatever buying side you're going to see from the compliance or even selling from the compliance side, right? That is just being dwarfed by what's happening in the investor flows. And certainly, if you looked at the ICE, commitment of trader data, another good place to look at in terms of seeing what's happening to the structure, of holdings. I wouldn't say it's the best data source in the world. It's not always that stable. And it can tell you very different things from week to week. But generally, basically what it shows is open interest from compliance guys are down. You probably expect that because A, all the UK installations have left, and B, the power sector, which is holding most of that open interest in derivatives, is decarbonizing, consistently decarbonizing. So you would kind of expect that, but the change in net length amongst the investment community is, has been significant, and that is a change in net length of 100 plus million tons. And that's where that is why we're above 50, is because you've had so much investor money come into this market. And if it continues at pace, then we will just see upside from here. If it comes off, then we probably stabilize around 50. And which of those two is incredibly difficult to call, because we just you have very, very little sight on what the investor community is going to do.
Absolutely.
Could I add in a comment here?
Of course.
Richard?
Sure, Bjarne.
So our outlook, is for carbon to move to 75 euro per ton in Q3. And that's sort of quite simplistically on the back of oil prices moving higher into Q3, well, which of course will depend on COVID-19 and Iranian supply and a certain future. But our general take is like yet higher oil prices, averaging like $75 in Q3, sometimes at 85, and then just higher gas price on the back of that, and then dragging carbon prices higher. But so that is kind of that part of it. But of course, the politics this summer is going to be hugely important. And then back to the speculators, when Timmermans is commenting on the carbon market trading at 50 and slightly above, saying we need much higher CO2 prices to get where we need to go. That is an extremely bullish statement, in my view, from one of the key politicians, and could also be some guidelines for what we should expect coming out of the revision this summer in July, and probably a bullish view. And with all the politicians stating all the things they want to get done by 2030, right? And then the market or a speculator or a fund should ask themselves, is 50 euro really enough to get us there by 2030 with these massive reductions every year? And I think the probable answer is that 50 is not enough to get us that far, that quickly, and then adding in the bullish politics. So I would bet that the speculators are still bullish at 50 in that respect.
Yeah, Ingvild, can I bring you in here? Yeah, please. Please,
I would really much like to comment on this.
Of course.
These prices, because I think, even though Timmermans says he won't 50 is not enough, I think you have several policymakers that, not necessarily saying that 50 isn't the bad carbon price, but I think when you see how far or how the price rise have been since November, that this is quite difficult for emitters in the EU that needs to be in this market for compliance reasons. And I also think that, you can say that, of course, you need a higher than 50 carbon price, but carbon price of 50 won't trigger much abatement today. You have the possibility, if you have gas in the power sector, to trigger these abatement. And we saw that in 2019 when prices were hitting 25 and you had low gas prices, that emissions were dropping 9%, and that came mostly from the power sector. But then, of course, what about for industry players? They will need a longer lead time to do their investments. They will have to invest in technology that are not available today. And of course, you see already politicians from Spain, from Denmark, which is considered as green, that this price increase that we have seen so far this year is a problem. Is a problem for the emitters and those that actually need to be in this market, that doesn't have the option of leaving or going forward. So I think if we see prices just rallying and continuing rallying up to 70, 75, then I think that will be harmful for the policy debate that will take place. It's a lot of the factors that needs to be fleshed out. You have the overall target, so the cap needs to be tightened. But for instance, the market stability reserve, and when you had the previous review, you wasn't supposed to touch the market stability reserve. And then you were discussing policy when it was at a really low price level. And then you said, well, okay, we have market stability reserve at hand. We can double the intake rate to tackle the oversupply. We just published our annual carbon market survey, where participants believe that this 24% intake rate to MSR, how much of the surplus in the market that you will soak into this reserve, will continue at 24% after these first 5 years. It's supposed to go back to 12%. But of course, this is at jeopardy when you are having a completely different price level, because policymaking is not made in a vacuum. So I think if you see prices rallying, and especially if policymakers are pinning this to speculative activity, to financial investors, that this will hit the European power prices. And you will also if you have industry players saying, well, this is harmful to us, then that could also influence the policy debate.
So if you get this chorus of voices putting pressure on the policymakers, if prices, continue to remain very strong, then you could see maybe, although Timmermans said that there wouldn't be any market intervention, maybe there could be increased calls for that, Ingvild. Is that what you're saying?
So Timmermans, of course, that could be an indication that the Commission won't put forward that you will have a market intervention. But it's not Timmermans who's deciding this. I mean, he is kind of representing the Commission, and the Commission put forward a proposal. I mean, this will be up to the member states, politicians in the member states and in the Parliament. So even though kind of that's the recommendation and that Timmermans says that, but if kind of policymakers and enough policymakers think this is a problem, then you will see kind of the proposal will be changed or could be changed, and it will for sure be part of the policy debate, even if the Commission is not proposing this.
Trevor, before we end today, I'd just like to talk a little bit about these speculators, these investors that are coming in. I mean, who are they, and are they here to stay, or is it going to time for a sort of quick buck and they move on?
Yeah, no, I think that's a good question, because that's that's the big driver. And I mean, I think there is a lot of new money coming in, and there is a lot of hedge funds getting involved, and there's a lot of proprietary investors. And we put out a piece a while ago called the Carbon Super Cycle, which kind of said, here are all the reasons for investing in carbon, right? And you look at the kind of debate that emerged in 2020, and 2020 really became all about massive increases in carbon emission reduction ambition on a global scale, right? You already had Europe leading, but then you saw a big increase in US ambition, a big increase in OECD, Japan, Korea, a big ambition, of course, in non-OECD with China. So you saw this huge increase in China, and lots of talks about the energy transition and what that means. And one of the questions, if you're an investor, is how do you trade the energy transition? What commodity looks good? How do I get exposure to all of this ambition, right, globally? And yes, you could say there's a few metals out there that maybe look good, because they will be needed as part of the transition. But you can't really trade oil. You can't go long oil. You can't go long gas. You can't go long the usual commodities. So you kind of may be left trading a bit of equity. But of course, you have company risk inside that. So maybe that's not great. So what looks good? Well, carbon looks great. Carbon looks like the one thing that's guaranteed to get scarcer. You had an analytical consensus, certainly around the EU ETS, that carbon prices were going to go up, right? Maybe, analysts differed a bit on the timing, but everyone was saying prices are really going to go high because of the Green Deal, right? So this just looks like, a market that was a structural bull and really calling out for investors saying, we're here. And of course, as that happens, and some of the things that, was being alluded to, also begins to happen. So you look at, the price of EUAs going up. This has real world impacts, right? All of a sudden it's changing power prices. And as you go from, free allocation, which is all about not passing through costs, to a carbon border adjustment mechanism, which is all about passing through costs, then all of a sudden the inflationary impact of the EU market becomes much greater. And all of a sudden you get a whole bunch of people wanting to use the EU ETS as an inflation hedge, right? So expect more money to come in from there. We think that investors, because of all of these dynamics around, around policy making and around energy transition and net zero, means that this money is probably going to be here to stay. We have to get used to, as a market, a lot of investment money coming in, a lot of investment potentially going out. But, there will be a lot of investor flows around this market and a lot more interest from investors than historically we've kind of lived with. And so it is, when you're looking forward, and I think one of the big analytical challenges for all of us is this, is to kind of start to call, how much investor flow do we expect to come into this market to hold for things like being an inflation hedge, being, getting exposure to the energy transition, all of these things that carbon is going to start to offer to investors.
Excellent. Bjarne, can I just have a final word from you? What's your view here on carbon as a hedge against inflation?
Well, if you look at the European economy, look at the amount of fossil energy consumed in the power sector, which accounts for 50% of the EU ETS emissions. It's like 3,000 terawatt hours worth of pre-combustion fossil energy. And the total consumption of fossil energy in the EU plus UK in 2019 was 15,000 terawatt hours of fossil energy. The European economy, the EU economy, is hugely fossil-based economy. So as you drive up the CO2 price, you drive up the energy cost in the EU, inducing energy inflation. So that's for sure. But just commenting on this issue of political intervention in the carbon market, of course, politicians will intervene. It is a purely political market. I mean, they have intervened many times to prop it up and fix it in many different ways and to get rid of surplus and everything. And of course, if speculators corner this market and drove it to like 200, 300 euro per ton in no time, of course politicians would intervene, no doubt about it. It's a purely political market. But I think one important question that Trevor raised is, despair by investors looking for the new economy and where to invest, ending up in carbon. Because we are all looking towards the energy transition, the new energy world, the new economy. But it's not there yet, because it's not yet profitable. It's kind of so profitable. But if you look at the EU to 2050 to do the job of decarbonization, in my rough calculation, you need at least like 250 billion euros invested in the power sector every year to 2050. And the question is, how do you release those investments just flooding into the market? Because that's what you need. You need to make these things profitable. And I think this goes back to Timmermans saying we need a much higher CO2 price. We need that much higher CO2 price to make it profitable, to release these massive investments needed to actually do the transition. If we just stay here, well, yeah, it's happening on the margin, right?
Guys, we're running out of time now, and we haven't even covered the UK ETS, which has had the first day of trading this week, on this very day when we're recording. What a lively discussion from this Point Carbon reunion. So thank you very much, Ingvild, Trevor and Bjarne. And I hope to speak to you all again soon.
Our pleasure. My pleasure.
Thank you very much. Thanks for having us.
So listeners, you can now follow the podcast on our own Twitter account, aptly named the Montel Weekly Podcast. Please direct message any suggestions, questions, or, let us know if you think you have a good idea for a guest on the show. You can also send us an email to podcast@montelnews.com. Lastly, remember to keep up to date with all that's happening in energy markets on Montel News. You can subscribe on Apple Podcasts and Spotify, or wherever you get your podcasts from. Thank you and goodbye.